Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm going to feature 12 undervalued dividend growth stocks. And a secondary purpose of this particular video is that I want to use real-world examples here to illustrate not only the power of value investing, but the four primary advantages that investors can get when they can find really attractive undervalued dividend growth stocks, especially to choose or to invest in over the long run. The first research candidate I'm going to feature here is Ameriprise Financial. I'm going to take price and the normal PE off this graph for a minute. I want you to see that this company has a really good growth rate. It's A-rated, has 43% debt. It can be bought at an 11 PE or 10.9 PE with a 2.6% dividend yield. But as I put the price on this graph, I want you to notice a couple of things. One is there is this tendency for the price to track earnings over the long run. But I also want you to notice there are tendencies for the price to get significantly undervalued over numerous periods on here. And then I want you to notice what happens once the stocks do get undervalued. And this is going to allow me to focus on the first advantage of buying an undervalued stock. I believe the company is currently undervalued with a 10.9 PE. If you look at its normal PE ratio, it's traded at 13 times earnings historically, and that's because of these periods of undervaluation. But somewhere between 13 and 15 times earnings would represent a very attractive valuation, and you can now buy the stock at an 11 PE. Now, from a standpoint of looking to the future, which is what this is all about, if you look at the forecasts of 11 analysts that are following the stock for this year and next year, you can see they're forecasting a really great year this year, followed by a 8.5% growth rate the next year. So the point is, you've got some natural leverage here. The current PE is 11. If the stock goes to a 15 PE, which is what I would think, or it's actually a 16.3 PE on this particular graph, because of the forecast growth rate is above 15%, you can see that the rate of return potential going out for the next 2.5-3 years would be over 35%, 36% a year annualized. If I go to a 3 to 5 year trend line graph, there is one analyst forecasting 18% growth. That would give you a 27.86% average annualized rate of return going forward. But let's go back to the historical graphs because I want to show you something very interesting. I'm going to pick a time frame here where the stock was undervalued. I'm going to do the end of 2011 or the beginning of 2012 when the stock was trading at a PE ratio of 9.9, and then I'm going to measure that out to 2014. So what you've got here is a 3-year period of time where you had the PE expand from 9.9 to simply the 15.5 like I was illustrating a moment ago. But here's what I want you to see that's interesting. I'm going to use the scroll bars here and scroll into these time frames. Now here's what I want you to see. This is the real natural leverage that I talked about in the written portion, or PE ratio expansion that I talked about. The PE went from 9.9 to 15.5. The company's earnings growth rate during this time was 19.4%, but your annualized rate of return was over 40% because you had this leverage. You had the PE expand from the 9, I can't touch it because I've got it scrolled off of the graph here, going up to the PE of 15.5, where it ended in December 31st, 2014. So over this 3-year period, the company grew at an exceptional 19% a year, but investors averaged over 40.5% a year, over 40% a year annualized, simply because they got the natural leverage of buying a stock when it was undervalued while it moved back into closer alignment with fair value. The second example I'm going to look at is AmerisourceBergen Corporation, a healthcare distributor, A- rated, has 64% debt, can currently be bought at a 13 blended PE ratio with a 1.8% dividend yield. But what I want you to notice here, the normal PE and the historical fair value PE of 17.8 and 17.4 are pretty similar. But here's what I want you to see. When I put price on the graph, I want you to notice here that the price tracks earnings again like it always does. It's the business that generates the long-term returns. This is the weighing machine concept of Ben Graham, but we get periods of undervaluation like I covered a moment ago with Ameriprise, but then you also get these periods of very high valuation. And this is where I can calculate risk a little bit. I talked about a second advantage is that you get lower risk. You see, if a stock falls from being highly valued to being undervalued or to even going down to fair value like you would see here, and I'm going to shorten this time frame so you see this a little more clearly, the real risk here of buying an overvalued overvalued stock like this is we've already gone, we'll call it 1, 2, 3, 3.5 years. We're nowhere near what the original valuation was. The stock was trading at $113 a share, and it was significantly overvalued on March 31st, 2015. And as of yesterday close, it's only at $83 a share. But if you have the stock where it fell from being reasonably valued, for example, back here in 2016, when the stock was trading at a PE of 14, we've almost recovered. We've actually made a slight profit because of dividends, but we've almost recovered. So there's a lot more risk. You take a lot more risk when you pay a high valuation for a company than you do when you're buying at fair value. You're going to tend to get a recovery much quicker if you buy a fairly valued stock. Big difference between a stock falling from being overvalued versus a stock falling from being fairly. The next research candidate I'm going to provide is Hanes Brands Inc. And it's kind of a controversial subject recently because this stock had a precipitous drop here just a couple of days ago, and you can see some downside in earnings, but you can buy the stock at a 10 PE with a 3% dividend yield. It does have a lot of debt, so this is maybe one of the more risky stocks, but once again, you see the danger of overvaluation where the stock was significantly overvalued in 2015, and now that's led to, over the next couple of years, a 14% annualized loss or a 45.6% total loss. However, now we've got the exact opposite situation. If you look at estimates, the company is not expected to grow very much, but if this stock just simply moves back to normal valuations, let's say the value investor stands to make very significant rates of return over the next couple of years. And if it does grow back at a 4 or 5% growth rate like some analysts are forecasting, you could annualize at 16.8%. So you would get the natural leverage again of PE expansion, even in a case here where you have very little growth expectations going forward. Now this brings me to a discussion of showing IBM. I've invested in IBM a couple of years ago for the dividend yield, and I've got nice dividend increases, as you can see here at the bottom of the graph. Actually, if I go down to the performance report, I've got nice dividend increases. I haven't got much in the way of capital appreciation, I might add, but I do consider this stock to be perennially undervalued here. But here's the key. This company is not expected to grow very fast. And so if you go to this normal PE over the last 5 years of 11, I still have a stock that can generate about an 8% rate of return. And for an A+ rated company like IBM, that's really not that shabby. Longer term, it's only expected to grow at 1.5%. But again, if I go back to that 13 PE type range, I could end up making 9% a year. If it goes back to a more rational 15 PE, I could make 11% a year. So value investing is a long-term approach, and IBM is definitely a company in transition, but they have continued to increase their dividend, and the stock is clearly significantly undervalued today. So you get all the benefits undervaluation can bring, even when there's no growth, and IBM is a classic example. My next research candidate is Intel, and again, you can see price tracks earnings. You can see periods where the price gets disconnected from earnings. We have some cyclicality in a stock like Intel, but their dividend record is really quite good. They did freeze the dividend in 2013 to 14, but the company's average growth rate of their dividend has been about 11%. This is a pretty good record for a company with this kind of cyclicality. Its long-term performance is about equal to the S&P 500, but I do want to point out that Intel is undervalued now when the S&P 500 is overvalued. The stock it trades at a 12.8 PE, 2.4% dividend yield. It's A+ rated with only 26% debt, and the rates of return going out for the next couple of years could be averaging over 15% annualized. And if you look out 3 to 5 years based on analysts' forecasts of 9% growth going out, you could still average over 13% going forward. And again, the analysts have been pretty accurate in forecasting this company. So here's another case where you have undervaluation, which lowers your risk, but also leads to good valuation. Notice when the stock got overvalued here with a high PE ratio and a price of 26.9, it was still several years later before we actually saw the stock recover to that period of time. So you pretty much had flat money as far as growth. The only thing you got was the dividend. And again, it's the danger of overvaluation. There's a significant difference between a stock falling from being overvalued compared to falling when it's being fairly valued or undervalued. Here it was actually undervalued even though it was cyclical, and it fell to about 27% during that period of time. But from December of 2012, when it was trading at $20 a share, By June of 2014, it was trading at $30 a share and ended up making you about 35% a year. So this idea that you take lower risk when you buy undervalued stocks and then simultaneously generate higher total returns continues to be validated under real-world circumstances. Another intriguing research candidate is Lithia Motors Company, an automotive retailer, car dealerships. And again, I want you to see that when the stock fell from being overvalued, it's been over 2.5 years and we still haven't had any recovery. But when it fell from being fairly valued, like it did in 2016, even though the stock is undervalued again today, you still would have ended up making a nice rate of return. I think this really highlights how you lower your risk when you buy these undervalued stocks. But if you're looking forward to what the forecasts are, this company could generate a 36 to almost 37% annualized rate of return if it goes back to normal valuations over the next couple of years. Now, it yields 1.3%, trades for less than 10 times earnings. It's BB plus with only 25% debt to capital, and it's forecast to grow very nicely at over 13% over the next couple of years. The longer term growth rate is even an astounding 25%, but there's one analyst. So here's a case where you could generate unbelievable long-term rates of return, assuming all these forecasts and everything pass. And this company has an excellent analyst scorecard. I want you to know that the analysts have been able to get this company pretty close to right. Virtually 100% of the time. It's either beat analyst estimates 60% of the time, or they've hit analyst estimates 40% of the time. So these estimates might have some credibility. This would be a great opportunity for a high total return at low risk based on low value. My next research candidate is Owens & Minor, a healthcare distributor, and healthcare distributors are all under siege and under assault. This company did have a significant drop in earnings. Otherwise, the market has a history of applying a pretty high valuation to this stock, but I want you to notice that this has really well overshot the drop in earnings. Earnings growth was down 21% in 2017, coming into 2018, which is expected to recover quite nicely. But you can see if you just look at it for this year, and I kind of missed it there by a month, but we've had over a 50% drop in stock price on a 21% drop in earnings. If I go down to the forecasting calculators, the analysts, there are 8 analysts following the stock, they expect nice growth over the next couple of years. And this gets back to a 15 PE. The opportunity here is extraordinary, and the risk, I think, is quite low. If it goes back to a 17 PE, the numbers would be even greater. Remember, I mentioned in the beginning here that this stock has typically commanded a high PE. Those are what-if scenarios, but the point is you can see there's a lot of opportunity here, but your risk is greatly mitigated. Your dividend yield is very high here. And by the way, this company has a pretty good opportunity to continue to pay and raise that dividend. Their free cash flow generation, however, has dropped below, but that's been the case in the past. Their operating cash flow numbers, I do believe they support the dividends, but there obviously is some cyclicality here in this company. So this would be a little riskier just on the standpoint of the business itself, BB rated with 47% debt. But on the other hand, it's got a risk-reward ratio that's pretty intriguing because of the low valuation. Now here's Penske Automotive Group, another automotive retail dealer. This company has some really, high dollar dealerships, BMW, Porsche, and names like that. It trades at less than 11 times earnings, 10.6 times blended PE ratio, 2.7% yield, BB rated with only 25% debt. But again, the stock is significantly undervalued, which means that your rate of return could be 20% plus over the next 2 or 3 years based on the consensus of analysts following the stock. And if you go out longer term, it could still be 13 or 4% based on the long-term forecast growth rate. The point is, it's the undervaluation that makes this stock attractive, even more so than the fundamentals of the business. Here's Prudential Financial Group, another example of a very undervalued stock. Trades at less than 9 times earnings, offers a 3.6% dividend yield, has a really excellent dividend record, although they did cut their dividend being a financial company during the Great Recession, but otherwise the dividend has grown very nicely. The stock is undervalued today, which once again gives it the opportunity to generate above average rates of return going forward. If it trades at its normal PE of 10, you still could make over 20% a year, 15% a year going out to the end of 2020. So here again, it's another case of undervaluation is what makes this stock attractive. It has an A rating with only 21% debt, which I think is also very attractive. My next research candidate is Walgreens Boots Alliance. In my last article, I covered CVS, but here again, you have another case where you have this correlation of price to earnings. You have the market that likes to price this stock at a high valuation. You can see the danger of a stock falling from being overvalued down to becoming fairly valued versus the stock falling from being attractively valued to getting significantly undervalued. And you can see how quickly they recover, as I covered earlier. But you've got an 11 PE at 2.6% yield, BBB rated with 30% debt. This is primarily a lot of fear about Amazon getting into the pharmacy business, but the stock is significantly undervalued. Its normal PE has been about 17 over the last 5 years. This means or implies very, very high annualized rate of returns, over 33% a year, going out to 2020. On their long-term growth rate, it's forecast to be about 10.5%. That would still look at 17% rates of return. So you've got very attractive annualized rates of return potential with this stock. You've got an analyst scorecard that's virtually perfect, 100% meeting their analyst estimates. So, these estimates could be reasonably accurate, and you've got a lot of upside in this company. But again, primarily attributed to the fact that it's undervalued. And, I also want to use this one to illustrate the other advantage of buying. When you buy a stock when it's undervalued, you tend to get higher yield. I want you to notice that you could buy Walgreens at a 2.7% dividend yield, one of the highest it offered, even higher than it does today, in August of 2012. And that coincides with the stock being very undervalued over that time frame. And even at today's undervalued level, that led to over 13% gains. And once again, you've got a very high yield, 2.6%, one of the highest yields that you see on this historical graph. You've got one of the great undervaluations. So one of the other advantages of buying these stocks when they're at value is you get a higher yield in addition to the lower risk, the higher total return potential, as well as the PE expansion potential. And then the last research candidate that I'm going to cover from an overvalued perspective is Whirlpool Corporation. And, this is the company that makes household appliances. It's BBB rated, has 42% debt, offers a 3.5% dividend yield and a 9 PE. Now, there is some cyclicality in this stock, but once again, if this stock moves back into its normal valuations, the annualized rate of return out to 2019 would be over 60% a year. The long-term forecast growth rate is just under 9% a year, which would lead to 20% plus annualized rates of return. So this is an example of a very excellent opportunity, primarily attributed to the low valuation, not necessarily to the fact that and by the way, there's some tariff concerns here that cause that, but that's what you want to do. You want to exploit, you want to be greedy when others are fearful and fearful when others are greedy. Now I've got one last stock that I want to cover here, primarily because I was asked to, and that's the Kraft Heinz company, which obviously is it's only been public since July of 2015. It's been reorganized several times. It was part of Philip Morris at one time, etc. But I want you to notice how highly the market was valuing the stock on its original IPO. But over time, this stock has reverted to the mean, if you will, and it is now coming close to fair value. It is not an undervalued situation, but if you look at its historical performance since it recently went public again, it has been abysmal, a negative, including dividend income, an annualized loss of 5% a year, turned $10,000 into $7,700, but it's now coming to a point where it's at least attractively valued, where it might be able to start generating some decent rates of return going forward. However, I do consider this company still fully valued to moderately overvalued, but I wanted to show this because I think it really gives the picture of how risky overvaluation can be, even when you've got a quality company like Kraft Heinz. Although it only is a BBB rated company, but it does only have 28% debt to capital. Anyway, this has been Chuck Carnival. I hope you enjoyed these research candidates. I hope you got a better perspective of the 4 advantages that buying undervalued stocks can give you: natural leverage, higher yield, higher total return, and lower risk. If you like what you saw here with Fast Graphs, give us a call, as you can see on the screen here, or email us at www.fastgraphs.com. Anyway, thanks for watching.